Let's talk about brokerages at TD Ameritrade. Full disclosure, of course, TD Ameritrade is the parent company of the TD Ameritrade Network. Tim Hockey is the president and CEO, joining us from New York Stock Exchange. Tim, good to have you on the program as always. So walk us through the numbers from this quarter first, because the shares had a little bit of a relief rally today, and analysts feeling pretty good about some of the revenue growth here. Walk me through it.
Well, simple answer is that last quarter seems like old news now, Oliver. No question it was a great quarter to end what was a great year in 2019, but as far as the analysts were concerned, first thing this morning, all they wanted to talk about was life post-commission cuts. So while we had record net new assets, record trades year over year, all those numbers were great, record earnings, and it's a brand new world in the brokerage industry, as you well know.
So, Tim, this is the big question, right? Which is how much of what we see on a trailing basis applies going forward. Things like growth rates, any sort of backdrop here is the same blueprint. How does it get applied going forward?
Well, what I've been explaining is to the casual observer of our industry, when you say your price that is primarily what clients are focused on is that, that big headline number of the commission per trade goes from $6.95 down to zero, lots of people will automatically say, well, how can you make any revenue whatsoever? That's not how we make our money, as you know. So simple math is, we just announced 2019's revenue number of about $6 billion. Our expense number, about $3 billion. Tells you that we've got 50% margins. If you just took our 2019 numbers and reflected a commission going from $6.95 to zero, our revenue numbers on a pro forma basis would be about $5.1 billion. So $5.1 billion in revenues and $3 billion in expenses. So margins go to around 40%. Our job now, of course, is to take that new level of profitability and to grow it back up as fast as we can. The good news is that we think, as I like to describe it, our segment of the wealth management industry, the online broker or the discount broker, was born out of price competition. 1975, right? Mayday. Price point back then was $75 a trade, but that was a huge deal against the full service brokers that were charging $300 or $400 a trade. And so it's been an inexorable slide from that $75, $50 price point all the way down to now, zero. So retail investors have been big winners.
Now,
we think, however,
go ahead, Tim.
A common playing field, that we have a great opportunity to grow, right? And so that's what we'll be focused on in the next little while.
About the growth here, the question is, are there going to be costs associated with going out and getting the business, bringing new accounts over? Is that going to be the first priority? Because you still obviously make the money on accounts, you make money off the order flow. So I imagine the first order of business here is getting as many people still basically on the platforms as possible. Absolutely. We think there's a great opportunity to grow from here. If nothing else changed, just the fact that we've gone from $6.95 down to zero will drive an influx of accounts. In fact, we just announced that in the first couple of weeks, we've seen an uptick in account activity by about 50%, and we've seen many other very positive indicators. Net new asset transfers in, ACAT transfers out being down. All of those things are indicative of a greater opportunity to compete and win. Tim?
Inside even going to a price point of zero, you have to understand that, as you well know, Oliver, TD Ameritrade had a commission price which was a couple of points or a couple of dollars more than our nearest large competitors. And so now it's all negated out to zero, and in a world where we're just working on the client experience and competing on that client experience, we're going to win.
And now, when you look at the rate that you mentioned, pretty incredible, the 50% growth, what's sustainable? Do you have a way of kind of figuring out how much of the market share TD Ameritrade can take? What kind of growth rate? I imagine 50% is going to be pretty tough to keep up.
Yeah, it's very tough to figure out, and I'm sure everybody's examining their daily numbers now to try and figure out what happened. So a couple of early indications. We know, for example, that the average trade size, the notional of our equity trades, is actually floating down a little bit. That was just new data I got today. That makes sense, right? When people are trying to say, well, how do I optimize my trade? If you take out the cost of the trade, make it zero, then people are chunking their trades up into smaller numbers. Our percentage of trades coming from equities versus options is also going up a little bit more.
On the other hand, our share of both options as a share of the entire trade levels of options and our share of equities is eking up just a little bit. So I think all of these factors are going to take just weeks and months to figure out, and we'll report out on our next quarterly earnings as to what the trend is. What we told the street, however, was the early signs are promising, but they're mostly just anecdotes. All we have to do is be conservative in our outlook, be nimble to make sure we're reacting to all those positive forces, and beat the competition day in and day out.
Tim, I want to try and go a little bit different direction from what the analysts have been asking you all morning, all week, all month. I know everybody's asked about M&A. People can go and see your response to that. I don't think you're going to tell us who you want to buy if you want to buy someone right now. But in terms of that growth and how important it is, your pitch here now is basically TD Ameritrade has the best platforms to trade. Since cost is no longer an option, come over to us. Now, what really started this is obviously the advent of trading on things like Robinhood, zero fees, new entrants into trading, young people. How important is it to go and get that market now that it can be either educated, do different types of trading, or now understand that with price without a barrier, they can become more sophisticated? How much do you need to target that demographic?
Yeah, well, first of all, we get more than our fair share of the millennial and the younger investor. But what we're really targeted on is what we call the empowered segment. The empowered segment tends to skew a little bit older, tends to have more money, because frankly, that's who trades a lot, who has the opportunity to drive revenue for us. On the other hand, the whole attitudinal fragment, if you will, of that segment is what's most important. These are clients who enjoy being involved in and actively be responsible for managing their money. That's very different than what we would call a supported segment client who says, yeah, it's just scary, I'm not interested in it, I just want to do and hand it over to an advisor. That's not the space we're in. So now in a world where, again, we're on a level playing field with other competitors who are at a zero price point, why would you go to a substandard platform that doesn't have the tools, the offerings, the education, the network, you and all of our gang on the TD Ameritrade network? All of that is value-added services that you get with TD Ameritrade. So as a result, again, on a level playing field from a price point of view, we are going to grow faster, and that includes many younger investors who will grow along with us.
Tim, when you talk about growth, innovation, we've talked before about tech's role in a brokerage, but you also mentioned on the report that strategic actions might be a part of this future for TD Ameritrade. Tell me how you balance the two. Does that mean cuts to expenses? Does it mean cuts to workforce? How do you both innovate and still take those actions?
Yeah, well, in many times when when you have a revenue cut to your business model, some businesses and some industries will just do what we call a peanut butter approach. You know, everybody has to stop watering the plants. We're trying to be more strategic about it. In fact, about 18 months ago, we started a program called Strategic Resiliency, because we knew all the tailwinds that we had going for us in the last little while weren't going to remain forever. So what we've done is we've taken a look at that $3 billion of expenses that we have to provide all the services we have and said, there's three buckets. The first one is, and is the most important, and that is the differentiators for us. What really makes us different, stand out from the crowd, why people would come and do their brokerage business with TD Ameritrade. The second bucket is, those are the things that we just need to keep the lights on, right? The clearing services, the statementing, you name it. And then there's a third bucket, which are those things that aren't necessary to run the main business and aren't differentiated. And so if you think about those three buckets, the first one, the differentiators, you want to make sure you keep investing in. The second one, you want to make as efficient as possible, with keeping the lights on. And the third one is you want to make some choices that are often harder choices to get out of those individual businesses and take the expenses there and redeploy them back on the opportunities to win. So Steve Boyle, our CFO, on the call this morning, gave some color as to what those types of choices might be in the future and what they have been in the past. But there's more to come on that front, because we're going to make sure we're investing in those areas where we can really stand out from the competition.
Tim, last question. Has there been given any thought to revisiting prices paid for order flow with the commission fees gone now? Is that a place where there can be more margin extracted if the brokerages are in that fight together?
I don't think so. After you've had a price action like this, I think what will actually happen is that all brokerages will start to truly examine their value created for their different client segments and line up the price that they can actually charge. In many cases, I think prices will be shifting to other value propositions. I think payment for order flow, in my view, is a completely legitimate revenue source, because what it means is it pays for services that retail clients don't have to. They get better order execution, as you well know, and that we pass along that price improvement to our clients. So it's a net win, and it's a way that retail clients don't have to pay. So I think there will be lots of examination about revenue sources, and as I say, aligning revenue to value perceived by clients.
Tim Hockey, pleasure as always. Thanks for joining us here on Market on Close. Tim from the New York Stock Exchange is president and CEO of TD Ameritrade.